Good morning or good afternoon to everyone. Thank you so much for joining. We're particularly happy to be hosting this webinar today as it's a rerun of an in-person seminar James and I hosted in Dubai at the end of last year, which unfortunately got slightly hampered by the Dubai traffic. So we're really pleased to get this out again to a wider audience. For those of you that don't know me, my name's Charlotte Knight. I'm a partner in the Dubai office of WFW. I sit in the assets and structured finance team that specialize in maritime transactions. So given time is short, we'll get cracking straight away. In today's increasingly volatile geopolitical and regulatory landscape, the drafting and interpretation of charter party contracts has never been more critical. From the ripple effects of sanctions regimes and trade restrictions to the operational disruptions caused by regional conflicts and environmental regulation, the legal framework underpinning maritime contracts is under intense scrutiny. There is a general perception that charter parties are relatively stable and predictable contracts, partly to the consistency of English law and its role in forming a strong body of maritime precedent, as well as the widespread use and acceptance of BIMCO standard forms. As a result, lawyers are often not involved in the negotiation or drafting of charters unless the charter is for a particularly high value, for a long tenor, and/or involves a specialized or complex asset. We are, however, seeing this perception of stability being tested and are often seeing legal issues and claims under charter parties arise more often. The webinar today will explore some of the more recent charter party developments, both in terms of contractual innovation and judicial interpretation. James will examine how some of the recent case law is shaping the way clauses are enforced and the key takeaways from these. And then we will look at three of the key BIMCO developments from the last 12 or so months, with some suggestions as to what you might be looking to change and negotiate when acting for either party to a charter. Ultimately, our goal is to equip you with some of the insights which, when you come to negotiating your next charter party, you need to be mindful of, and when you might think you need to call WFW for help. So now I'll turn over to James to introduce himself and take us through the case law part of the presentation.
Great, thank you, Charlotte. Good afternoon, everyone. I'm an associate in the Maritime and Dispute Resolution team in our WFW Dubai office, and I work primarily with partner Natalie Jensen to handle a range of wet and dry shipping disputes, and we also advise clients on a range of maritime commercial matters. As Charlotte's mentioned, I'll be providing a toolbox of key chartering and general maritime issues to have in mind by reference to recent case law. So for each issue, I'll focus on a case or two, highlighting the practical takeaways and the legal principles to have in mind. So turning straight to our first case, we all know that due diligence on counterparties is crucial for several reasons, both in a chartering and a broader contractual context. For example, to ensure creditworthiness or compliance with sanctions and any associated contractual reps and warranties. The English Commercial Court in White Rock and Middle Folga, the first case on the slide, provided a helpful reminder of this lesson. To a brief overview of the facts, first of all, there was a fixture for the charter of 4 vessels in March 2022. The recap identified White Rock as charterers. The registered owners were stated by reference to Q88 forms, which noted High Ocean and Global Logistics as registered owners. North Global was disponent owner, and Middle Folga was not mentioned at all on the Q88s. Only 3 of these 4 vessels were ultimately delivered, and these were withdrawn from service between March 2023 and February 2024. On the 25th of March 2024, White Rock issued a claim of around $12.6 million for wrongful withdrawal, and the claim form named both North Global and Middle Folga. Following service of the claim form, Middle Folga challenged jurisdiction, asserting they were not bound as they weren't a party to the charter. In relation to party submissions, White Rock asserted that Middle Folga was the actual party they were chartering from, such that Middle Folga was an undisclosed principal, that is, a party who had authorized an agent to act on their behalf without disclosing their identity. Middle Folga firmly rejected this position, citing the charter signed by White Rock, which identified them and North Global as the contracting parties, and relying on the strong existing legal presumption that a party described as owner is responsible for chartering the vessel. among other points. In this case, the commercial court found in Middle Folger's favour that it was not a contracting party, highlighting the Q88 forms, which identified North Global as disbanded owners, such that the vessels have been chartered from Middle Folger and onwards to White Rock in that contractual chain. Owner's confirmation in the recap that the vessel had no Russian connection, including as to commercial ties. Middle Folger was a Russian company, so such a statement indicates a clear intention that Middle Folger was not a contracting party. And finally, the overwhelming majority of contractual documents, aside from protocols of delivery, supported Middle Folger's position that they weren't a contracting party. So what are the key takeaways from this decision? Firstly, to ensure that key contractual documents and supplemental documentation is clear and consistent in identifying the contracting parties. That said, there remains a clear legal presumption that a party named in a contract is the principal, and convincing proof is needed to displace this presumption and to show that a named person is contracting instead on behalf of an undisclosed principal. Turning to the next key issue, which is limitation of liability. Under the Convention on Limitation of Liability for Maritime Claims, 1976, the LLMC 76 for short, ship owners can limit liability. That sounds straightforward until you realise that the ship owner refers not just to a vessel's registered owner, but also the charterer, manager, and operator. The Express Pearl is a recent case which it is useful to touch upon to illustrate the breadth of this definition. In that case, a vessel of the same name was carrying containers on behalf of three parties: Bengal Tiger Line, Maersk, and MSC, each described as slot charterers. The vessel caught fire and sank, leading to the loss of its entire cargo. The vessel's registered owners, bareboat charterers and time charterers, the claimants in this case, were permitted to constitute a limitation fund in the amount of approximately £19.9 million and obtained a decree limiting liability under the LLMC. The slot charterers applied to the English court for orders that they were ship owners within the LLMC's definition, who would therefore also be able to limit their liability arising out of the incident. The Admiralty courts in this case consider the prior authority of the MSC Napoli, in which the slot charterers, who made payment for slots allocated, whether used or unused, were held to be charterers for the purpose of the LLMC. In that case, it was noted that to fall within the definition of charterer and therefore be a ship owner able to limit liability, it was not a prerequisite for a party to have a right to use a vessel's entire cargo carrying capacity. In the Express Pearl, the judge emphasised the importance of a precise contractual arrangements in place, but also held that a party to whom space on a ship is contracted for performance by it, delegated to the ship of its contractual obligations as carrier, will generally be an Article 1.2 charterer, given the ordinary connotation of that word and the purposes of the Convention. Upon consideration of the contractual arrangements for each applicant, the court in Express Pearl considered each of Bengal Tiger Line, Maersk, and MSC to be charterers and therefore entitled to limit their liability under the LLMC 1976. Each party's contractual position was slightly different. For Bengal Tiger, they had an identical position to the slot charterers in the MSC Napoli case. Slots were allocated under a fixed slots contract with the time charterers, with fees payable whether or not the slots were used. For MSC, they had a connecting carrier agreement with the time charterers, under which slots were allocated and fees were paid for each slot used, but not for unused slots. While for Maersk, a slightly different position again, with an agreement for transport services under which freight rates were paid for by Maersk for services ordered from the claimants. This agreement for transport services was deemed a contract to make carrying space available to Maersk for higher slots, allowing them to fall within the LLMC definition. The key takeaway in this case is again that clarity in contractual documentation is paramount, as the court will review the precise arrangements to determine whether a party is a charterer under Article 1(2) of the LLMC 76. Next up, we have a case on the importance of the infectious disease clause and its interpretation. Now, as you'll know, this clause has become a Charter Party staple, particularly following COVID-19 and its wide-ranging and costly impact on shipping globally. The Admiralty Court judgment in the Sagar Rattan was an appeal brought following an arbitration concerning COVID-19 related delay. The disbent owners had a time charter trip fixed with charterers from the Philippines to Australia via China. Upon arrival in China, multiple crew members tested positive for COVID-19. Rather than the vessel remaining under quarantine in China, the owners decided to sell her to Ulsan, South Korea, in order to replace the crew. The vessel then returned to China for discharge of the cargo. The charterers deducted hire and expenses for a period of delay of approximately 2 weeks, and owners claimed this withheld hire at an MAA arbitration. The tribunal decided in favour of charterers as to the deduction of hire, and in doing so concluded the owners could not rely on the amended BIMCO clause included in the time charter. Owners, however, were granted permission to appeal on the following points, which brings us to this decision by the Admiralty Court. Firstly, as to the BIMCO clause, is a port or place an affected area in circumstances where the crew had a disease as defined upon arrival? As to clause 38 of the Charter, which was a quarantine provision, with respect to off-hire, does detention for quarantine of the vessel arise if a vessel sails elsewhere to replace her crew? And finally, as to additional clause 50, which was a deviation clause, is the vessel off-hire during a period when it can and does comply with the service immediately required? The owners, as appellants, unsurprisingly submitted that a port which imposes quarantine due to crew COVID infections does constitute an affected area carrying a risk of quarantine or other restrictions, and the vessel therefore remained on hire. There was no detention if the vessel can sail elsewhere, and therefore again the vessel remained on hire. And finally, the immediately required service, said the owners, was to replace the crew, which took place, and therefore again the vessel could not be deemed off hire. The Admiralty Court, however, conclusively dismissed the owner's appeal. On the BIMCO clause interpretation, the court explained the two limbs of affected area, namely risk of exposure to the vessel, crew, or others on board to the disease in question, or exposure to a risk of quarantine or other restrictions imposed in connection with it. And that second point is the key point of focus for the Admiralty Court in this case. The risk of quarantine or restrictions was held to be a general risk arising from the disease, which does not have regard, for example, for the strictness of national quarantine or testing policies. This risk also applies where a risk of quarantine arises due to having visited a port affected by the disease in question. The court therefore upheld the tribunal's decision that the owners could not rely on the BIMCO clause, as Biocan was not an affected area. The quarantine arose from the crew being infected, which was a characteristic of the vessel and or the crew, rather than a characteristic of the place of discharge ordered by the charterers. As to the quarantine provision and that question of detention, the vessel having sailed to Ulsan for crew replacement didn't affect the fact that detention had occurred in preventing the vessel's core venture, which was discharge of the cargo. Quarantine was such an event which prevented the vessel's entry, such that the vessel was off hire under this provision. Finally, on clause 50, the deviation clause, the court decided that the vessel was not providing the service immediately required. Relying on prior case law, the court held that crew illness resulting in quarantine restrictions, compared by analogy to an engine breakdown resulting in delay during repair, is an event outside of the ordinary way of a charter party, such that a vessel cannot be deemed to have remained on hire during the period of delay. Key takeaway from the Sagar Rattan is that the judge struck a pragmatic, balanced approach to interpretation of the BIMCO infectious diseases clause. The interpretation reached is consistent with the general principle that delays arising from a vessel or crew are for owner's account. This means the vessel would not be off-hire under the amended BIMCO clause in the charter in question, due to problems which would not have arisen but for the provision of an infected crew. Next is a case about responsibility for payments, duties, taxes, and tariffs, which, as we all know, can be an important and very expensive element of chartering costs for the party responsible. As I'm sure you'll know, the allocation of port costs depends on the type of charter, with voyage charters conventionally providing for such costs to be for the owner's account, while under time charters, this responsibility is usually allocated to the charterer. The case of Port of Sheerness and Swire isn't one that's strictly about the allocation of costs between owner and charterer, but it might be one to have in mind when negotiating allocation of costs and accounting for potential change to operational port costs during the life of a charter. In Port of Sheerness, the port sought to impose a period toll against Swire, who are the subcharter and operator of an overstaying vessel, the MV Kieting. Cargo was loaded in late 2021 and was due to be discharged at Tilbury, but due to storage limitations, part of the cargo was instead discharged at Sheerness. There were delays in discharge. The total time taken was just over 56 hours against the port's estimate of 42 hours, and the port sought to charge Swire a period toll of approximately £248,000 in reliance upon the terms of its contract. The port had 4 submissions on its entitlement for period toll. Firstly, as a matter of contract, Clause 5.4 of the port's terms provided that a period toll could be charged where a vessel remains alongside at the docks for a longer period than necessary for loading and discharging of cargo. The court found against the Port of Sheerness on this point. It held that the words remains alongside was to apply in circumstances where the vessel did not depart after completing operations, and not where loading or discharge took longer than estimated. In reaching this view, the court adopted a practical and commercial approach, stating the port's interpretation would be complex, uncertain, and all too readily productive of disagreements. Secondly, the port relied on a unilateral power to impose additional charges under its terms and conditions, which provide for charges for delays outside of control of the port. This was likewise rejected by the court, who decided that the wording cited referred to the port's terms and conditions rather than providing a standalone right to impose additional charges. The court also rejected the port's third submission in deciding any supplemental agreement reached in correspondence between Swire and the port, referencing the period toll and cargo handling charges, did not impact the parties' agreement, given the interpretation reached of Clause 5.4. And finally, the port's claim for a quantum merit sum, reflecting the value of services provided to Swire, was also rejected. The current situation was not one in which the parties had stipulated additional charges would be payable by Swire. So the key takeaways on this case are that helpfully for those across the maritime industry, the courts will continue to adopt a commercial and pragmatic approach. And from a legal perspective, a misconception between the parties, even if it's one that they share, does not alter a contract meaning or context. Moving on from charter parties to a couple of cases which cover the key points of importance on the Hague and Hague Visby Rules. The first of these is the Taiku Brilliance, and for this case, Article 3, Rule 6 of the Hague Visby Rules is the main point to have in mind. This provides in relevant part that the carrier and the ship shall be discharged from all liability whatsoever in respect of the goods, unless suit is brought within 1 year of their delivery, or the date on which they should have been delivered. To the fact of this case, the vessel owners issued 4 bills of lading to the holders for timber carried from New Zealand to India. Discharge took place in September 2019 without production of the bills. The holders alleged misdelivery by the owners, but didn't commence arbitration until December 2020, crucially over a year after the alleged misdelivery. However, in that time, the holders had issued a writ to arrest the sister ship in Singapore. Arbitration was commenced in May 2022, and owners argued that the holders' claim was time-barred. This claim was rejected as arbitration, and following the arbitration, permission to appeal was granted, with 2 questions for the commercial court to address. Issue 1. Were the Singapore arrest proceedings a suit for the purposes of Article 3, Rule 6? And secondly, what is required by the words which the contract of carriage is stated as being carried on deck in the definition of goods at Article 1C? As to the first issue, it was held that the Singapore arrest proceedings were for security rather than to establish liability, and therefore were not a suit capable of stopping the clock on the 1-year time bar under Article 3, Rule 6. This decision in favour of owners was based on a commercial and purposive approach to interpretation. The purpose of Article 3, Rule 6 is deemed to be to achieve finality and to enable accounts and books to be closed. As to the second issue, 2 of the 4 bills identify quantities of cargo carried on deck, but not the exact parcels being carried. The practical question was ultimately whether both elements had to be included on the bill. Again, the court adopted a pragmatic approach, holding that the requirement under Article 1C was satisfied. There isn't a one-size-fits-all approach to drafting a bill of lading. The holder must be able to identify whether the goods carried fall within the Hague Visby Rules. So the key points to have in mind are that for the purpose of the Hague Visby Rules, the time bar under Article 3, Rule 6 cannot be stopped by arrest proceedings. And secondly, there is not a one-size-fits-all approach to cargo deck statements, which, as you would expect, can differ depending on the nature of the cargo. Turning to my final case, which is that of Tanga Pharmaceuticals. And this case addresses a slightly different point within the Hague Rules, but is likewise important for establishing when a suit under the rules is brought. Alongside Article 3, Rule 6, Article 3, Rule 8 of the Hague Rules is the important provision to have in mind here, and it's on the slide with key points in bold. In this case, Tanga were the owners of 548 containers on board the vessel, and the containers were shipped under bills issued by Emirates Shipping Line FZE, the charterer. The bills incorporated the Hague Rules by a clause paramount. The vessel's engine broke down in September 2021, and following discharge of cargo against provision of salvage and general average security, a settlement was reached between Tanga and Salvors. Tanga was granted multiple extensions of time for issuing proceedings, and they eventually issued a claim 4 days before the expiry of the extended time bar. Emirates Shipping sought to argue Tanga's claim had been time-barred because of a couple of provisions in the bill's terms. So Clause 18 provided that any claim against the carrier for any adjustment, refund, or with respect to freight, charges, or expenses, or any claim other than for loss or damage to goods, must be submitted fully documented to the carrier or its agent in writing within 20 days from when the goods were or should have been delivered, failing which a claim would be time-barred. There was also a service provision under which suit should not be considered to have been brought within time specified unless process shall have been actually served or jurisdiction obtained over the vessel or the carrier within such time. The court rejected the defendant's position as to the time bar on the following basis. Clause paramount, which is included, explicitly excluded Article 9, and therefore there was no indication that Article 3, Rule 8 was similarly excluded. Clause 18 did not explicitly state that it prevailed over the clause paramount, which was required given that Tanger would have relinquished rights under the Hague Rules. And the so-called service provision, stipulating when suit is considered to have been brought, did limit liability and therefore was rendered null and void and of no effect, as under English law, suit is brought when the claim form is issued rather than upon service. So what are the key takeaways to have in mind from Tanger Pharmaceuticals, particularly when contracting in practice? The effect of a clause paramount is well known as a clause by which the Hague Rules are incorporated into the contract, evidenced by a bill of lading, which overrides any express exemption or condition that is inconsistent with it. Drafting of this clause is therefore key. And finally, where the Hague and Hague Visby rules apply as a matter of contract, clear words are required to depart from their effect, including for Article 3, Rule 6 and Article 3, Rule 8. So that concludes my section, and I will now hand over to Charlotte to address key BIMCO updates and revisions.
Great. Thanks very much, James. As James says, I'm now going to go through the sort of contractual part of the session. And just to point out that in the resources button at the bottom of your screen, there's links to the relevant BIMCO clauses being discussed in case you want to cross-refer to any of the relevant provisions. So first, I'm going to look at the BIMCO Fuel EU Maritime Clause, and this was put in place by BIMCO in response to the EU fuel regulation, which has been effective since the 1st of January, but has been sort of brought back into our consciousness most recently because the compliance measures start from this month. So the purpose of the regulation, it's part of the EU's Fit for 55 climate package, with the ultimate goal being the decarbonisation of the shipping sector by reducing the greenhouse gas intensity of fuels used on board. The EU regulation covers all commercial cargo and passenger vessels over 5,000 gross tonnes, calling at or between EU ports, regardless of their flag. In relation to a vessel's geographical coverage, the regulation applies to 100% of fuel used for intra-EU voyages and 50% of fuel in voyages between EU states and non-EU states. The key elements of the regulation is that vessels must reduce their greenhouse gas intensity of onboard energy use compared to a 2020 baseline. The reduction targets are scaled in the following way until 2050. 2% until 2029, 6% by 2030 to 2034, and up to 80% by 2050. To ensure compliance, ship owners are recommended to begin using low carbon fuel options en masse, but if only a selection of vessels use low carbon fuels in their fleet, their usage can be offset against more greenhouse gas intensive vessels. What are the ramifications for non-compliance? Well, these are fines in the amount of 58 euros per gigajoule of non-compliant fuel, and these penalties escalate by 10% annually if non-compliance continues. The regulation currently holds that it's the owner or the holder of the vessel's document of compliance which is responsible, i.e. they may bear liability and risk towards the state authorities, despite lacking ability to directly influence fuel choices for chartered vessels. Owners will in turn look to recover these costs from the charterer at a contractual level. However, it's likely charterers will in turn try to negotiate compensation from owners where they exceed the targeted usage of low carbon fuels. And this is where the BIMCO clause came in. So what does the clause look like? There are a series of template definitions regarding relevant EU regulations, the measurement of the greenhouse gas emissions and reporting periods, i.e. per calendar year. The clause itself places obligations on owners to ensure adequate greenhouse gas intensity monitoring is in place for vessels and that they upload data to the Fuel EU online database during each reporting period. Owners must also provide data up to the date of delivery of the vessel under a charter so that the charters have that vessel's recent history of Fuel EU status and can negotiate the charter accordingly. Using this data, owners must then notify charterers of what's called a compliance balance during the time on hire, This is the measure of a vessel's over or under compliance with regard to the limits for yearly greenhouse gas intensity of energy used on board. In a simplified version, if during time on hire the compliance balance has a negative value, a penalty will need to be paid. The clause creates a mechanism for the owner to recover this penalty from the charterer by imposing a surcharge, having provided an independently validated calculation based on the reporting. Similarly, if the charterer has proved to be over-compliant, the owner is obligated to reimburse or compensate the charterer. Charterers can also elect to pool their positive compliance balance and offset it against reporting periods with a negative compliance balance. However, should a charterer fail to pay a surcharge as per the frequency of payments agreed between the parties, the clause gives the owner the right to suspend performance by giving 5 days' notice until payment is received in full. Parties should also be aware that if a charter period covers at least 2 consecutive reporting periods and the vessel maintains negative compliance for the last 2 periods or more, a charterer must pay an amount in liquidated damages in addition to the surcharges mentioned, i.e., this is where an owner could stand to benefit. So as mentioned, according to the regulation, it's always the owner or the document of compliance holder who's assumed responsibility for the vessel and does not include time charterers. Consequently, the EU regulation does not reflect industry understanding, that being the principle of the polluter pays. The contradictory approach of the EU has therefore necessitated parties to clearly allocate responsibility for compliance between themselves at a contractual level. The BIMCO clause does this by allowing ship owners to pass the external responsibility onto the time charterer, i.e. the actual polluter. As a result, the BIMCO clause seems a welcome addition and is a good starting point, but users should be aware it does not address everything. For example, how to arrive at a price for compliance with the regulation. There are also a number of points left open for negotiation, and the clause should always be tailored to the transaction at hand. We will, however, look at a few key provisions now where you might seek to amend or you might come to WFW to help negotiate your charter. So first, looking at the issue of the compliance balance on delivery. As mentioned, the BIMCO position requires that the owners to disclose the vessel's compliance balance for the previous 2 reporting periods. And as mentioned, a negative balance can lead to escalating penalties. So the charterer's risk is that it could inherit a vessel with a negative balance and unfairly expose them to increased penalties. Therefore, from a charter's perspective, you might want to amend the clause to include a warranty from the owner that the vessel will be delivered with 0 or a positive balance, and or an indemnity in case a negative balance leads to increased penalties during the charter period. From an owner's point of view, of course, they would want the charter to accept the vessel as is and have no liability for any prior balance. Looking now at responsibility for the penalties. So the clause places regulatory responsibility on the owner, but the commercial responsibility for compliance and the penalties on the charterer. The risk for the charterers, they may be liable for the penalties, but they don't lack the full control over the compliance mechanisms. When we talk about compliance mechanisms, we mean the technical capabilities of the vessel and the vessel's performance. From an owner's point of view, the owners could be liable or the owners are liable to the authorities regardless of fault. So for acting for a charterer, you may want to clarify that penalties arising from owners' failure to maintain the vessel's technical compliance are not for the charterer's account. And from an owner's perspective, you may want to strengthen the clause to expressly indemnify owners for all fuel EU penalties arising from charter-controlled decisions. When we talk about charter-controlled decisions, we mean fuel choice, voyage routing, and speed. As regards alternative fuels, the BIMCO position is that charterers may provide alternative fuels, but it's only if they are agreed upon in the charter and subject to the owner's prior approval. The risk for the charter here is that they have limited flexibility to meet fuel EU targets through biofuels or other low carbon options. But on the flip side, a risk to owners, if they allowed any fuel at the charterer's choice, is that the vessel could be subject to technical or safety issues or possibly an invalidation of the H&M cover. So from a charterer's perspective, you may want to amend the clause to include a clear right for charterers to supply compliant alternative fuels subject to reasonable technical and safety considerations and requires owners to cooperate in good faith. From an owner's perspective, you'd want to ensure that they have to give prior written approval for any alternative fuel, include a technical due diligence process such as class and engine maker approval, and clarify that costs of tank cleaning, trials, and any delays are for charterer's account. Pooling, banking, and borrowing. The clause allows charterers to instruct owners on pooling, banking, or borrowing, but only if the charter period covers the full reporting year. So for charterers, the risk could be that they are excluded from these mechanisms and limiting their compliance options. So charter may want to allow pro rata pooling or banking rights with shorter charter periods, or negotiate a mechanism to share the benefits of any positive compliance balance. The owner risk is that there could be a misuse of compliance credits, which could affect future charters or the owner's compliance strategy. An owner therefore may want to ensure that owner's consent is required, includes a cap on the amount of compliance balance that can be borrowed or pooled, and ensure the charter indemnifies for any adverse consequences. In terms of data reporting and timing, the owners must provide the compliance data within 15 days of each voyage. The charter risk is that delays in data revision could hinder timely compliance decisions on their side, i.e. whether to pool or pay the surcharge. The charter therefore may want to include penalties or consequences for late or inaccurate data provision and extend timelines to reflect realistic verification of the data. The owner's risk is that the 15 days is quite tight and there could be a potential dispute over data accuracy. So they may want the reporting period extended to something like 30 days, include a dispute resolution mechanism for disagreements, and clarify that the owners are not liable for delays caused by third-party verifiers. Surcharge and reimbursement mechanism. The BIMCO position is that charterers pay a surcharge if the vessel is under compliant, and reimbursement is only possible if the compliance balance is negative and improved to zero. So from charterers' point of view, there's no benefit for over-compliance, and there could be a risk of oversupplying biofuels without compensation. They may therefore wish to negotiate a credit or rebate mechanism for positive balances, especially if they are retained by the owner upon redelivery. The owners, on the other hand, may think that the charterers will push for rebates on positive balance and therefore would like to exclude any obligation to reimburse charterers of positive balances unless expressly agreed in advance. And if agreed, ensure the owner retains discretion as to whether to pay and at what rate. So that's just a non-exhaustive list of some points you need to be mindful of in incorporating and negotiating this clause in the charter. And we at WFW have a dedicated ESG team that can guide you through this process. So please don't hesitate to reach out. Moving on now to the BIMCO con-wartime clause. So the purpose of this clause is a method for navigating war risks in time charters. The several revisions of this clause since 2004, 2013, and now last year in 2025 have enabled it to be adapted to reflect evolving geopolitical threats and industry practices. It has three primary functions, those of risk avoidance, cost allocation, and allowing operational flexibility. So as regard risk avoidance, owners can refuse to send a vessel to areas deemed too dangerous to war risks based on reasonable judgment of the master or the owner. And these threats can encompass war, piracy, terrorism, civil unrest, and blockades. In terms of cost allocation, the clause provides that if a vessel proceeds into a war risk area, charterers must reimburse the owners for additional war risk insurance premium, kidnap and ransom insurance, and a new addition from the 2025 update, crew bonuses. In terms of operational flexibility, the clause grants parties the liberty to deviate, sail in convoy, or comply with any safety-related instructions as necessary. Owners are also not obliged to load contraband or pass through blockades. Ultimately, the con-wartime assists parties to navigate legal and financial exposure in volatile regions, for example, the Red Sea, Gulf of Aden, and other conflict zones. And this clause was particularly thrown into the spotlight last year when the Strait of Hormuz was threatened to be closed. Commercial continuity is ensured while the vessel, crew, and cargo remain protected. From a legal perspective, standardized terms aim to reduce disputes and align expectation between owners and charterers. So looking at the clause itself, and in particular more the key updates that were made in the 2025 revision, Much of the 2013 clause remains, but the notable updates are the following. There is now definitions of insurance costs and area. Insurance costs includes expenses for additional war risk and kidnap and ransom cover due to the vessel entering a war risk area. An area is formally defined as any location where war risk may be present. Looking at additional insurance next. So under the 2013 clause, charterers were required to reimburse owners for additional premiums without any detailed justification. Owners must now show they use reasonable endeavours to secure appropriate cover and terms when seeking reimbursement. They must notify charterers of insurance costs promptly and ideally before entering the war risk area. Charterers are only required to pay net costs, which excludes any discounts or bonuses. So the new addition was crew bonus, as mentioned, and under the 2013 clause, there was no requirement on owners to prove to a charterer that crew bonuses were paid. Owners must now prove the crew received any stated bonuses via an invoice and sign receipt or confirmation from the crew manager. Liberty clause. The 2013 version allowed vessels liberty to comply with orders, directions, recommendations, or advice whatsoever. The term whatsoever has now been clarified to include any form of guidance, even if it is informal or precautionary. Furthermore, vessels are given more operational freedom, such as sailing in convoy through war risk areas, complying with any safety-related instructions, whether formal or not, and able to deviate from the route if necessary. Any ambiguity as to whether the vessel is on hire during this instance has also been dispelled. Vessels remain on hire during any of the events just described. Consequently, owners are protected from losing hire due to safety actions, and charterers retain operational continuity without triggering an off-hire dispute. In terms of alternative port nomination, charterers now have 72 hours, up from the previous 48, to nominate a safe alternative port when owners refuse discharge due to war risks. Cost disputes mechanism. Under the 2013 clause, there was no mechanism for charterers to dispute excessive premium. An owner can now be challenged on unreasonable insurance costs. So the update to the clause seems to be welcomed by the market by balancing the use of war risk clauses. Owners must document their war risk claims and enhance transparency in circumstances where clauses are being used frequently and unmeritorious claims by owners may be more likely. However, there is a critique that the clause does not take into account recent developments, such as those as the automatic identification system manipulation used by the likes of Russia, Iran, and Venezuela as a method of asymmetric warfare. For those that don't know, this is where the system is used to broadcast fake signals, clone legitimate vessel identities, and create ghost ships that appear on tracking systems but don't exist. So in doing a similar exercise as before, looking at some of the key provisions and where you might seek to negotiate them. So the definition of war risk in the BIMCO is pretty broad. As mentioned, includes war, terrorism, piracy, but from an owner's perspective, this could be broader. You may want to also include cyber attacks, drone strikes, and hybrid warfare, and consider adding states, cyber operations, and autonomous weapons system. On the flip side, the Charter might want to narrow this to exclude vague or emerging threats, such as cyber incidents, unless state-sponsored and or confirmed, and require objective criteria or third-party confirmation. Looking at the right to refuse dangerous areas. So the position under the BIMCO clause is that the vessel is not obliged to proceed to or through areas deemed dangerous by master or owners. Owner's friendly amendment may be to clarify that the owner's discretion is final and binding and not subject to challenge unless manifestly unreasonable. The Charter may wish to require that refusal be based on objective evidence or government advisories and not just owner's discretion. It could also add a requirement that consultation be necessary with the Charterer. In terms of insurance costs, as mentioned under the BIMCO clause, the charterers have to reimburse for additional war risk and premiums, but the owners must show reasonable efforts to obtain appropriate cover. The owner may want to limit the charter's ability to challenge the level of premium, clarify that owners may choose reputable insurers even if more expensive, and even add a clause that the owner's choice of insurer is final and binding. The charter, on the other hand, may want to have to give prior written approval of the insurer and be notified of the premium level and even possibly negotiate a cap on reimbursement to market rates, or at least require competitive quotes to be obtained. In terms of crew bonuses, as mentioned, this is a new addition. The owners must provide proof of payments of crew bonuses. The owner-friendly amendment might wish to limit the form of proof to written confirmation from crew managers, avoiding requiring individual signed receipts, whereas the charter may want a detailed documentation breakdown, including crew contracts, receipts, and confirmation and verification that those payments were made and indeed received. The Liberty Clause, the vessel under the BIMCO standard may comply with any orders, directions, recommendations, or advice whatsoever and will remain on hire during this time. The owner may want to emphasize that not only during these times that the vessel remain on hire, but also during any deviation or delay due to war risks, including convoy sailing or waiting for instructions. The Charter will want to limit liberty to reasonable deviations and maybe even allow off-hire if deviation is excessive or not pre-approved. So for alternative port nomination, the charterers under BIMCO have 72 hours to nominate a new port if the original one is deemed unsafe. The owner may want to reduce this back to the 2013 48 hours to minimize off-hire exposure, and possibly add that if no nomination is made, owners may proceed to a port of their choice at charterer's risk or expense. Charterers, of course, will want to extend this time for as long as possible, and perhaps even make the owner wait for charterer's nomination unless the delay is unreasonable. So lastly, you're going to be looking at the BIMCO USTR clause. So this was introduced by BIMCO last year, as under the Trump administration, the United States Trade Representative introduced its notice of action to impose fees on all Chinese-built, owned, or operated ships calling at US ports. In response, BIMCO published its USTR clause in July of last year to combat arising contractual uncertainties. Although from October last year, we obviously have a halt on the imposition of the fees, we still think it was important to cover this clause, as time always flies. 10 months is not a very long time away, and things are certainly uncertain out there in the world. So the purpose of the clause is designed to allocate responsibility for US service fees imposed under the notice. The position is that the charter will be responsible for fees except where the vessel owner fails to make a declaration or an accurate one as to the vessel's Chinese nexus, or there are changes at the owner-operator level directed by the vessel owner incurring increased fees. The clause also designs to ensure transparency regarding a vessel's Chinese nexus in terms of ownership, construction origin, or operator. And it gives a contractual mechanism for charters to request declaration from owners about possible Chinese affiliations. So at the charter's request, the owners must declare in writing whether the owner, bareboat charterer, disponent owner, and or manager are a Chinese entity, and or if the vessel was built in China. So at the time, the clause was necessary development in the sector in reaction to the USTR notice of action by expressly creating a contractual framework to allocate compliance and financial responsibilities. The clause can be readily included into template agreements for new charters or incorporating into existing ones, but there are several key aspects which parties should be mindful of before doing so. So clarity in charter party terms. Clear contractual language should be used when specifying responsibility for fees. In terms of operational readiness, owners and charterers should verify that managers, crews, agents, and relevant third party are familiar with the USTR notice to avoid delays. Owners are also advised to prepare for making ownership declarations to new or existing charterers. In terms of cost allocation, charterers will need to budget for the USTR fees as part of their port call expenses. And generally, parties just need to stay abreast of developments, because although we know what the USTR clause looked like last year, when it comes back into effect in October, it could look very different. Thankfully, we have a dedicated team at WFW monitoring the US-China position, so do reach out if you're unsure. So looking at some of the key clauses and where we might seek to negotiate these when acting for owner or charterer. So in terms of disclosure obligations, the standard BIMCO position is that the owners must declare if the vessel is Chinese built or operated by Chinese entities and notify charterers of any changes. The owners may seek to limit the obligation to reasonable endeavours and information within their knowledge and control, perhaps avoiding strict liability for errors in third-party information, such as that provided by third-party managers or operator changes. From a charterer's perspective, they may require warranties from the owners that all disclosures are accurate and complete, and include a continuing obligation to update charterers of any changes. In terms of financial responsibility, under the clause, the charterer bears the cost of USTR fees if they order the vessel to a US port. The owner may want to clarify that charterers remain liable even if the vessel is Chinese built or operated, provided the owner has disclosed this accurately. They could also add a broad indemnity for any USTR related costs, including legal fees and penalties. The charter may want to limit its liability to fees directly caused by its orders and only if the owner has fully complied with its disclosure obligations. In terms of inaccurate declarations, owners are liable for USTR fees if their declarations are inaccurate or complete. Owner may want to limit this liability to gross negligence or willful misconduct and include a materiality threshold for inaccuracies. The charter would want to maybe expand this to include indemnity for all losses, including consequential, arising from inaccurate or late disclosures. In terms of deviation and off-hire, the BIMCO clause is not clear on this at all, and so the owner and so both parties would be minded to clarify this. From an owner's perspective, the owner may want to clarify that the vessel remains on hire during any deviation or delay caused by USTR compliance or port entry restrictions. The charter may want to clarify that the vessel is off hire during any deviation, delay, or detention caused by USTR-related issues not attributable to the charterer. In terms of regulatory cooperation, again, this is not covered by BIMCO. So owner may wish to add a clause requiring owners to cooperate with them in regulatory filings such as the COFR CBP Form 1300 and to indemnify for misstatements made by charterers. The charter, on the other hand, may require owner to share all regulatory filings and obtain charter approval on them where relevant. In terms of sanctions and compliance, BIMCO has not expressly addressed this either and kept that as a separate issue. But the owner may wish to refuse orders that risk sanctions exposure, and the charter may want to require objective evidence of sanctions risk, including limit refusal rights. So that brings us to the end of our presentation. Appreciate there's a lot to unpack there, so do please reach out anytime. We also have a few minutes now to take any questions. I think there's one in the chat for you, James.
Okay. So we've had a question that's asked, has there been any challenge globally to the position under the LLMC 1976? So following the judgment I mentioned in the Express Pearl, interestingly, the Sri Lankan Supreme Court in July of last year ordered the Express Pearl Group, so the vessel's owners, operators, and local agents, and held that they were jointly and severally liable in order to make an initial payment to a Sri Lankan treasury of $1 billion. And this first payment wasn't made. It was due on the 23rd of September last year. And Express Feeders released a statement that it wouldn't be making payment until it had assurances that the compensation ordered by the Sri Lankan courts was aligned with international conventions. And that decision itself came with quite a bit of pushback, including from the one of the P&I insurers involved. So it really remains to see how the Sri Lankan position in terms of that order for a very significant amount of compensation will unfold and how it will interplay with the ongoing and sort of what remains the prevailing provision with respect to limitation of liability under the LLMC. And It looks like there's one for you, Charlotte, which is what do you see the most in terms of adjustments to the Fuel EU Maritime BIMCO clause? And are there any particular trends or points for on charterers or owners' side that are worth highlighting?
Thanks, James. I think the biggest point is one I highlighted at the start, where I think the clause doesn't address how to come at a price for the compliance. And I think this has been a point that has come up under negotiation and needs to be addressed by parties up front, and is something that I know that our ESG team is looking at in some detail, and is getting questions on that a lot. We've also had people inquire about, trading of the compliance balance, and that seems to be something that's of interest to the market, and that's in terms of people who are not even the owner of the charter but third parties. So I think these are the types of questions that we're going to see arise more and more.
Just checking to see if there are any others. There is one more just on the BIMCO infectious disease clause, which I'll take on this one. In terms of practical points that owners should have in mind regarding this clause. So again, one of the sort of practical takeaways coming from the Sagar Rattan case uh, was obviously around whether the circumstances around affected area in question were attributable to the port of discharge or to the vessel and or the crew. And so one of the key practical points is owners who might be ordered to trade in areas where there's a risk of an infectious or contagious disease should take measures as to testing and monitoring so that, if necessary, they can clearly evidence their reliance on protections under the BIMCO clause and be able to establish that circumstances around affected area and the reasons for delay are not attributable to a vessel or crew, but rather a characteristic of the place of discharge or the port in question.
Okay. I think there's any more questions. We're nearly at the end, 1 minute to go. So I think, unless there's nothing else, we'll say goodbye. And thank you, everybody, so much for tuning in today. And as we said, any follow-up questions, though, do feel free to reach out to James or I or any other member of the WFW team that you know.